Let's read the requirement first. Calculate the net present value of buying the new machine and advise on acceptability of the proposed purchase. So we have to find the NPV of buying this particular machine, and they're asking us to give a recommendation on that. And next they are telling, explain the difference between risk and uncertainty. So they're asking us to do the calculation for the nearest thousands. So let's go through the scenario now. While we are reading the scenario, we'll highlight whatever the important areas. Though company needs to increase the production capacity to meet increase in demand for an existing product, cargo, which is used in food processing, a new machine with a useful life of 4 years. 4 years and maximum output is 600 kilos. Could be bought for 800,000 payable immediately. The scrap value of the machine, the scrap is there, 30,000. And they have given the forecasted demand for the next 4 years. Year 1, 1.4, year 2, 1.5, year 3, 1.6, year 4, 1.7. Existing production capacity for cargo is limited to 1 million kilograms. So existing capacity is there only for 1 million kilograms for a year. The new machine would only be used for the additional to this particular demand, which you are getting additional demand for that one only. You are going to use this existing machine. Only be used demand additionally to this. The current selling price of a cargo is 8 per kilogram. That is the selling price. And variable cost of the material, variable cost is there, 5. Other variable cost of production, 1 kilogram, $9 per kilogram. Fixed cost of the production associated with the new machine would be 240,000. That is the fixed cost. In the first year of production, increasing by 20,000 per year in each year subsequent year of the operation. No company pays the tax 1 year arrears. The tax rate is 30%. Claim on tax allowable depreciation is 25% reducing balance basis. A balancing allowance is claimed in the final year of the operation. That is the balancing allowance in the final year of the operation. No company using its after-tax weighted average cost of capital when appraising the investment project. It has the cost of equity of 11. Before tax cost of debt 8.6. That's a before tax cost of debt. Long-term finance of the company on the market value basis, 80% consists equity, 20% consists the debt. So here we have to calculate the weighted average cost of capital also in order for us to do this particular question. In this question, first we'll try to identify whether the new machine has the capacity of fulfilling the excess demand that we are getting. So here I'll write the current demand. I'm doing this working for your understanding purpose. So current demand is there. Year 1, year 2, year 3, year 4. Year 1 is there for 1,400, 1.4 million, 1,500, 1,600, 1,700. Our old machine capacity is there for 1,000. Old machine capacity is there for 1,000, 1 million. They have given in the question. Existing production capacity is 1 million kilograms per year. So existing production capacity is 1 million. Then from the new machine, we want to get 400 in the first year, 500 in the second year, 600 kilos in the third year, 700 kilos in the fourth year. So that is the requirement that we have. But this question clearly says new machine can produce only 800 kilos for a year. New machine can produce only 600 kilos, 600,000 kilos for a year. So 600,000, 600,000, 600,000, 600,000. So for the appraisal purpose, we are going to use, even we can produce only 600,000, we should produce only 400,000 kilos. No? That's the requirement. No? For the calculation purpose, we have to take here this 400 kilos first year. Even the new machine can produce 600 kilos. We have a demand of only 400, so we have to take 400. Second year also same. Even we can produce 600. We have to take only 500 because our demand is 500. Third year 600, 600 it is matching. Fourth year there is a problem you see. Fourth year we have a demand, excess demand. So or 1700 demand is there. From the old machine we can fulfill 1000. So from the new machine we have to fulfill only 700. So here from the new machine, we can't fulfill the 700 because new machine capacity is only 600. So we have to take only 600 into consideration. So in this particular new machine, do remember there is a small problem. What's the problem that we have in the new machine? In the fourth year, we can't fulfill the entire demand. So here I'll write new machine capacity for your understanding purpose. Then here I'll write excess demand. Excess demand 700. So using these numbers only, we have to do the calculation, NPV calculation. So we'll start it. Let's do one by one. So let me add another one more column over here. So below this line, let me start to do the calculation. So year 1, year 2, year 3, year 4. And here let me take the year 0. Year 0. So first we'll take the extra sales that we could generate. Each kilo we are selling for $8. So sales, incremental sales because of the new machine, this amount into 8. Here also this amount into 8. Here also this amount into 8. Here also 600 into 8. To understand again why am I taking 600, even the excess demand is there for 700. Reason, our new machine has a capacity of only 600 kilos for a year. That's the reason. Now we can take that is done. Variable cost. So how much is the variable cost they have given? Variable cost of the material is $5 per kilo. Other variable cost of production, $1.9 per kilo. So variable cost. Then I'll take the total at once. 5 plus 1.9, 6.9. 6.9. So equals this amount into 6.9. Let me close the brackets. So let me take the same values for other ones as well. So that is also done. Now we can take the fixed cost. Fixed cost. So I'll take the contribution. I'm getting the contribution. Now let me take the fixed cost. So here let me put a line. So regarding the fixed cost, what are they telling? Fixed cost of the production associated with the new machine would be 240,000 first year, then increasing by 20,000. So first year 240,000 and it is increasing by 20,000. That means here 260, here 280, here 300. So with that, we are done with the fixed cost also. So now let's take the taxable cash flows. Taxable cash flows 200, 290, 380, 360. And now let's take the tax. They are telling tax is paid 1 year arrears 30%. Tax payable 1 year arrears you are paying. That means year 5 you also getting created because of the tax. Because year 4 tax will be paid in year 5. For 1 year arrears, year 1 tax will be paid in second year. So here this amount into 30%. 60, 114, 108. So tax percentage is also done. So next we can take the capital allowances based on the reduce imbalance method. So let me do a working for that. In this question, investment is 800. So 25% tax into 800 into 25% into 25%, 200. For this 200, we'll be getting 30% tax saving. So this amount into 30% tax saving. So I'll change the number to the percentage wise. Yeah, into 30% tax saving. So first year tax saving is 60, but first year tax saving 60 will be realized in year number 2. This is the year 1 tax saving. 60 is the year 1 tax saving, year 1, but it will be realized. It will be realized in year 2. Realized in year 2 because tax is 1 year arrears. Year 2. Then let's take the value over here. Here we are getting 600. Then 600 again. 25%, 150. 30% saving we will get. So 150 into 30%. It is 45. This is the year 2 saving. Year 2 saving will be realized in year 3. Year 2 saving will be realized in year 3. Then balance is 450. Again 450 into 25%, 112.5. 30% saving on that. So 30% saving, 33.75. This is the year 3 saving will be realized in year 4. So we have arrived at the last year. Last year we have the balancing allowance or the balancing charge. So as per this question, so here we are getting a value of 337.5. They have given a scrap amount of the machine. The scrap amount they have given, it is 30,000. End of the year, we can sell and get 30,000 from this particular machine. So scrap amount is there 30,000. Then here 30,000 minus this amount, we are getting a balancing allowance 30. So how much is that? 92.5. So this is a amount relevant for the year 4, but it will get realized in year 5 because we are paying tax 1 year arrears. So let's take the tax savings now. Tax saving. Tax saving. Always put equals and get the values, because if there is a change, always your other answers also will change when you are doing in Excel. That is the best practice. Don't just go and type the values. So ensure to follow the best practices. Then here equals 92.25. So we took the tax savings also. Now let's record the investment and the scrap. So investment is 800. Scrap is there for the 4th year. It is 30. Scrap is 30. Now we can get the net cash flows. So let me select this entire area and let me put the decimal places to make my calculation nice. Okay. So now let's get the net cash flows. $200, here 290, 338, 309.75 minus 15.75. So these are the net cash flows. In this question, we have to find the weighted average cost of capital. So they have given in the question, equity is there 80%, debt is there 20%. So equity rate is given 11% is the equity rate. So here we can take 80% into the 11%, it is 8.8. Then debt is 20%. But before tax cost of debt is there 8.6. So 8.6 is the before tax cost of debt. Then 8.6 into 1 minus 0.3. 1 minus 0.3. So we will get the after tax cost of debt. So after tax cost of debt is 6.02. After tax cost of debt we are getting 6.02. So let me put the percentage and let me increase the number of decimal places. Then we'll get the 20% of that. 20% of 6.02. So let me decrease the number of decimal places. Then here we are getting a final weighted average cost of capital. Final weighted average cost of capital of 10. So based on this people, now let's calculate the NPV directly using the NPV formula. Don't waste time by taking it manually. Open brackets, select the rate. Rate is this. I'm not going to type 10%. Always when you have a value inside a cell, select it. That's the best practice. Then select the cash flows from year 1 onwards. Close the brackets. Then adjust the year 0 cash flow separately. Then here we are getting NPV of 77.14. So we are done with the NPV number calculation. Next, they are asking in this question as the second part, advice on the acceptability of the proposed purchase. So here we can say, since the NPV is positive, it is acceptable to proceed with the investment. So based on the NPV, it is acceptable to proceed with the investment. However, in this question, there are certain things where we have to focus on. What are the things? One is, when it's come to the 4th year of the operation, our machine capacity is not there to fulfill the demand. So we have to consider that one as well. So we have to replace the asset after 4 years. So when we are replacing the asset after 4 years, we have to think about going for a bigger asset. So that particular factor should be considered when we are appraising the investment. It is noted that in the 4th year of the business, new machine does not have does not have capacity to fulfill the excess demand as the business has to replace the asset, replace the new machine after 4 years. So here, why I am telling business has to replace the new machine after 4 years? Because the useful life of the new machine only 4 years. After 4 years, this factor should be considered when making the investment. And next point, I would say further, it is noted that selling price and variable cost are not adjusted for inflation before making the final decision. This factor also needs to be considered. And further, I can give further points. You can say here they have taken an increase of the fixed cost in the same way, like 20,000 every year. What is the reason behind that? What is the reasoning behind that? Those things are not provided in this question. So in simple terms, as a summary, I would say when you are writing the comment for this particular question, don't just write since the NPV is positive, it is acceptable to proceed with the investment. Because in this particular investment appraisal, lot of other factors that we have to consider is not considered. So point out those problems also, then you will be able to go for the perfect mark of this particular question. Part B, they are asking, explain the difference between risk and uncertainty in the context of investment appraisal. In the context of investment appraisal, they are asking us to explain the risk and uncertainty and describe how sensitivity analysis and probability analysis can be used to incorporate the risk into the investment appraisal process. So here in this particular part B, they are asking few things. One is they are asking the difference between risk and uncertainty based on NPV, based on investment appraisal. That is one they are asking. So this is how we are breaking the question into pieces. And next part they are asking us to describe how sensitivity analysis and probability analysis. So they are asking how we can use sensitivity to investment appraisal, one part. Other one they are asking how probability is connected to the investment appraisal. So you see, if we break this question into pieces, one is difference between risk and uncertainty. That's what they're asking one in the context of investment appraisal. So other one is how we can use sensitivity analysis into the investment appraisal, how we can use the probability analysis into the investment appraisal. So you are given with 7 marks, right? So if I break these 7 marks for your understanding purpose, for the probability sensitivity analysis, you are writing for 2 marks. For probability analysis, you are writing for 2 marks. For the difference between risk and uncertainty, you are writing for 3 marks. So altogether 7 marks. By taking like that, you can score in this particular area. So let's construct a sample answer. Risk refers to situation where probability can be assigned for the outcomes. Uncertainty refers to situations where probability cannot be assigned. Risk will increase when project variability increases. Uncertainty will change with the life of the project. So here I am writing point-wise for your understanding purpose. You can write it as a paragraph. Okay. You can write it as a paragraph. Both factors are interconnected and should be considered when making an investment decision. So you can write this. So this is like a little bit comprehensive answer in point form I have given for you to get an idea. So you can elaborate and write these points. So for the difference between risk and uncertain based on investment appraisal, for that one, you can write this. Now we can move to the other 2 points. So we are not required to hang on 1 point and keep on explaining that 1 point because they have given 7 marks in order for us to write multiple things. So now we can move to the sensitivity analysis with the investments and probability analysis with the investment. So likewise, you can break and write. So for the sensitivity analysis, you are going to write it for 2 marks. Then for 2 marks, if you can write like good, so 2 solid or 3 solid points, that's enough. For the probability analysis with the investment, for that one also, if you can write 2 or 3 solid points, that's enough. Then you will get all the points which is allocated for those explanations. So let's construct few sample points. Sensitivity analysis will provide the detail of from which percentage a certain variable should change in order to reverse the decision. So in order to for us to reverse the decision, sometimes NP to become 0. If the NP becomes 0, sometimes we might reverse our decision. Okay. However, in sensitivity analysis, probability of certain variable changing is not considered, which which means risk is not incorporated. So in sensitivity analysis, we are finding from how much a certain variable or from which percentage a certain variable should change in order for us to reverse the original decision. Okay. But what is the chance of that particular variable changing? What's the probability of that particular variable changing? Is not discussed in sensitivity analysis. So with that, we can connect to the next point, which is the probability analysis. In the probability analysis, we are taking that particular percentage also, probability also into the consideration. In probability analysis, probability of future outcomes are considered when appraising an investment. There are situations which will lead to multiple scenarios for the outcomes. In this situation, joint probability analysis could be used for a better decision. So like this, you can write a nice answer for this particular question. You can enroll for my full ACCA course. I have done it for a very reasonable price. To get more details about my full ACCA course, check the description.